The compensation system that was supposed to align employee interests with company success actually prevented employees from recognizing and addressing the risks that would eventually destroy the company. The irony was that Fold's loyalty obsession, which was meant to prevent the kind of talent drain that had weakened Lehman in the past, actually made the company more vulnerable to catastrophic failure. By trapping employees in a system where leaving meant financial ruin, he created an organization where everyone was financially committed to believing that everything was fine, even when it wasn't. This collective delusion would become the foundation for the most aggressive expansion strategy Wall Street had ever seen. The rapid expansion that rebuilt an empire. Between 2000 and 2006, Lehman's revenues grew 600%, and their market cap rose from $5 billion to $40 billion. This transformation from a struggling American Express subsidiary into a Wall Street powerhouse required an expansion strategy so aggressive it bordered on reckless. When Lehman bought its independence back from American Express in 1994, Fold inherited a company that was profitable but small compared to its competitors. Goldman Sachs, Morgan Stanley, and Merrill Lynch had all grown larger and more influential during Lehman's decade under American Express ownership. Fold refused to accept second-tier status, so he launched an expansion campaign that would either make Lehman a dominant force or destroy it completely. Fold borrowed massive amounts of money to hire entire departments from competing firms, often paying signing bonuses that exceeded annual salaries at other companies. He wasn't just filling open positions. He was creating new business lines from scratch by acquiring teams of specialists who brought their clients, their expertise, and their existing deals with them. This approach allowed Lehman to enter new markets almost overnight, but it also meant they were competing in businesses where they had no institutional experience or established risk management procedures. Fold's acquisition strategy focused on companies that could generate immediate revenue growth, regardless of whether they fit with Lehman's existing operations. In 2003 and 2004, Lehman acquired Aurora Loan Services and BNC Mortgage to enter mortgage origination. Aurora Loan Services was a mortgage origination company that specialized in loans to borrowers with less than perfect credit histories. BNC Mortgage was another subprime lender that had built a profitable business, making loans that traditional banks wouldn't touch. These acquisitions gave Lehman direct access to the mortgage origination business, allowing them to create loans and then package them into securities that could be sold to investors. The mortgage company acquisitions represented a fundamental shift in Lehman's business model. Instead of just serving as intermediaries who connected borrowers with lenders, they were now directly involved in creating the loans that would later be packaged into mortgage-backed securities. This vertical integration seemed like smart business because it allowed Lehman to capture profits at multiple stages of the mortgage process. They could earn origination fees when loans were created, packaging fees when loans were securitized, and trading profits when securities were sold to investors. Each new acquisition added layers of complexity that made Lehman increasingly difficult to manage. Aurora Loan Services operated from different locations with different computer systems, different underwriting standards, and different regulatory requirements than Lehman's existing operations. BNC Mortgage had its own corporate culture, its own client relationships, and its own approach to risk management. Integrating these acquisitions required Lehman to coordinate activities across multiple states, multiple regulatory jurisdictions, and multiple business models simultaneously. The Asian financial crisis of 1997 tested Lehman's resilience and revealed both their strengths and weaknesses. While many competitors suffered significant losses from their Asian investments, Lehman's diversified business model helped them weather the storm. Their mortgage business was generating steady profits, their investment banking operations were busy with domestic deals, and their trading departments were profiting from the increased volatility in global markets. The crisis convinced Fold that diversification was the key to survival, encouraging him to expand into even more business lines. When the dot-com bubble burst in 2000, Lehman again demonstrated their ability to adapt to changing market conditions. While technology-focused investment banks struggled with the collapse of internet companies, Lehman's broader business portfolio insulated them from the worst effects of the crash. Their mortgage operations were thriving as low interest rates encouraged home buying, their bond trading business was profitable as investors fled to safer assets, and their private equity investments were generating returns from non-technology companies. The September 11th attacks presented Lehman with their most severe operational challenge. Their global headquarters at 3 World Financial Center was severely damaged, displacing over 6,500 employees and destroying critical computer systems. Trading operations were moved to Jersey City, New Jersey, and the firm spread its remaining operations across New York City in over 40 temporary locations, including the Sheraton Manhattan Hotel. This rapid relocation and restoration of trading capabilities showcased Lehman's organizational resilience and their employees' dedication to maintaining operations despite extraordinary circumstances. Lehman's international expansion accelerated during the early 2000s as Fold opened offices in Europe and Asia to serve global clients and access new markets. The London office became a major hub for European bond trading and investment banking. The Tokyo office focused on Asian equity markets and currency trading. The Hong Kong office handled private wealth management for Asian clients. Each international location operated under different regulatory requirements, different accounting standards, and different legal frameworks, adding another layer of complexity to an already complicated organization. Each successful crisis navigation increased Fold's confidence in Lehman's ability to handle any challenge. The Asian financial crisis, the dot-com crash, and the 9/11 attacks had all tested the company's resilience, and Lehman had emerged stronger each time. This track record of survival bred a culture of overconfidence where employees believed they could overcome any obstacle through aggressive action and creative problem-solving. The attitude became that if Lehman could survive a terrorist attack, they could survive anything. The diversification strategy that had protected Lehman during previous crises was also creating concentrated risks that weren't immediately apparent. Their mortgage origination business, their mortgage-backed securities trading, their real estate investment funds, and their commercial real estate lending were all generating profits, but they were also creating multiple exposures to the same underlying risk, real estate prices. If real estate markets declined, all these seemingly separate business lines would be affected simultaneously. By 2006, Lehman had grown from a mid-tier investment bank into a global financial services company with operations in dozens of countries and involvement in nearly every aspect of the financial markets. Their rapid expansion had created a complex organization that was difficult to manage and even more difficult to understand. But the most dangerous part of their empire wasn't the most visible. Hidden within their sprawling operations was a business line that appeared insignificant but contained enough risk to destroy everything they had built. The mortgage time bomb hidden in plain sight. Lehman Brothers' mortgage business appeared to be a minor part of their operations, with subprime and Alt-A mortgages representing just 3% of their total revenue in 2007. Most analysts and investors viewed this as a relatively small exposure that couldn't possibly threaten a company with $19 billion in annual revenue. But this perspective missed the fundamental danger lurking beneath the surface. The mortgage business wasn't just 3% of their revenue. It was 3% of their revenue that carried enough concentrated risk to destroy the entire company. The mortgage origination model seemed straightforward on paper. Lehman would acquire mortgage companies like Aurora Loan Services and BNC Mortgage, which would create loans for homebuyers. These loans would then be packaged into mortgage-backed securities that could be sold to pension funds, insurance companies, and other institutional investors. The beauty of this system was that Lehman could earn fees at every stage of the process, while supposedly transferring the actual risk to the investors who bought the securities. Aurora Loan Services specialized in Alt-A mortgages, which were loans to borrowers who had decent credit scores but couldn't provide full documentation of their income. BNC Mortgage focused on subprime loans to borrowers with poor credit histories who were considered too risky for traditional bank loans. Both companies were originating loans at an incredible pace. By 2008, Aurora and BNC were lending almost $50 billion per month, generating volume that seemed impressive, but also meant that quality control became nearly impossible as loan officers rushed to meet production targets. Lehman's executives believed they had solved the risk management problem by implementing a strict 30-day holding period for mortgages. Their strategy was to originate loans, package them into securities, and sell them to investors within 30 days. This approach seemed to limit their exposure to any single loan or borrower, since they would only be at risk for the brief period between origination and sale. The 30-day window gave them enough time to complete the securitization process while minimizing their exposure to changes in borrower creditworthiness or housing market conditions. The flaw in this strategy became apparent when Lehman decided to keep the highest-yielding portions of their mortgage securities for themselves. When mortgages were packaged into securities, they were typically divided into different tranches with different risk levels and different interest rates. The safest tranches paid relatively low interest rates, but were almost guaranteed to be repaid. The riskiest tranches paid interest rates as high as 12%, but were the first to lose money if borrowers defaulted on their loans. Most investment banks would sell all tranches to outside investors, earning fees for the packaging and distribution services. But Lehman saw an opportunity to earn higher returns by keeping the riskiest, highest-yielding tranches for their own investment portfolio. This decision meant that they were no longer just earning fees for processing mortgages. They were making direct bets on the performance of the underlying loans, essentially becoming both the casino and the gambler at the same time. The leverage strategy that Lehman employed amplified these mortgage risks far beyond what the revenue percentages suggested. Lehman's leverage ratio increased from approximately 24-1 in 2003 to 31-1 by 2007. This meant that for every dollar of their own capital, they were controlling $31 worth of assets. The mortgage securities they were holding weren't just small positions. They were leveraged positions that could generate massive profits if housing prices continued to rise, but could also generate massive losses if housing prices declined. To understand how dangerous this leverage was, consider a real estate investment analogy. If you buy a $300,000 house with a $10,000 down payment, you have 30-1 leverage. If the house increases in value by 10% to $330,000, you've made a 300% return on your down payment. But if the house decreases in value by just 3% to $291,000, you've lost 90% of your down payment. Lehman was essentially making this same leveraged bet on mortgage securities across their entire balance sheet. The mortgage strategy fit perfectly with Lehman's historical pattern of chasing profits without fully considering the risks. Just as the original Lehman Brothers had accepted cotton as payment without understanding commodity price volatility, the modern company was accepting mortgage risk without understanding housing market volatility. They saw the high interest rates on subprime mortgage securities and focused on the profit potential rather than the default potential. Their assumptions about real estate prices were fundamentally flawed. Lehman's risk models assumed that housing prices would continue to rise or at worst remain stable. The company's executives had lived through decades of generally rising real estate values and couldn't imagine a scenario where housing prices would decline significantly across the entire country. This assumption was built into their mortgage origination standards, their securitization strategies, and their risk management procedures. When housing prices began to decline in 2006 and 2007, both assumptions proved incorrect. Investor demand for mortgage securities evaporated as institutional investors recognized that the underlying mortgages were defaulting at higher rates than expected. Housing prices declined not just in isolated markets, but across the entire country, affecting the value of mortgages that had been originated in different states and different economic conditions. The 30-day holding period that was supposed to protect Lehman became meaningless when they couldn't find buyers for their securities. Instead of holding mortgages for 30 days, they were forced to hold them for months or even years. The high-yielding mortgage securities that had seemed like easy money became impossible to sell at any price. The leverage that had amplified their profits during the housing boom now amplified their losses during the housing bust. The mortgage time bomb that Lehman had built wasn't visible in their revenue statements or their public financial reports. It was hidden in the leverage ratios, the risk concentrations, and the flawed assumptions that underpinned their entire business model. What had seemed like a small, manageable business line was actually creating vulnerabilities that would soon be exposed when the company's overall financial position came under scrutiny. The $640 billion house of cards. By 2007, Lehman Brothers had constructed the most precarious financial structure in Wall Street history. The company reported record net income of $4.2 billion on $19 billion in revenue, managing $640 billion in assets across the globe. Financial analysts praised their diversified business model, their international expansion, and their ability to generate consistent profits across multiple market cycles. The stock price hit all-time highs, and Dick Fuld was celebrated as one of the most successful CEOs on Wall Street. Everything looked perfect from the outside, but the numbers told a very different story. The $640 billion in managed assets created an illusion of financial strength that masked a catastrophic vulnerability. Lehman Brothers had only about $22 billion in shareholders' equity, meaning their true equity ratio was under 4%. The remaining assets represented money that belonged to other people, money that Lehman was managing, investing, or borrowing against. This meant that over 96% of their supposedly managed assets were not actually owned by the company. They were essentially running a $640 billion operation with just $22 billion of their own money. This financial structure was like running a real estate empire where you own one house, but manage 30 others that belong to different landlords. If the rental market collapses, you lose income from all 30 properties, but you only have one house worth of equity to cover the losses. The difference is that most real estate managers don't borrow money against properties they don't own, but Lehman Brothers was doing exactly that across their entire operation. The leverage ratio that made this possible reached 31-1 by 2007, meaning that for every dollar their own capital, Lehman was controlling $31 worth of assets. This level of leverage was unprecedented for a major investment bank and far exceeded the leverage ratios used by their competitors. Goldman Sachs was leveraged at approximately 24-1, and Morgan Stanley was leveraged at approximately 28-1. Even these lower ratios were considered aggressive, but Lehman had pushed leverage to levels that were simply unsustainable. The debt-fueled growth strategy had worked perfectly during the housing boom when asset values were rising consistently. When you control $31 worth of assets with $1 of your own money, even small increases in asset values generate massive returns on your equity. If assets increased in value by just 3%, Lehman would earn a 93% return on their equity. This mathematical relationship explained why their profits had grown so dramatically during the mid-2000s housing boom. The same mathematical relationship that created substantial profits during good times guaranteed substantial losses during bad times. If the $640 billion in assets declined in value by just 3%, Lehman would lose $19 billion, which was almost their entire equity base. A 5% decline in asset values would completely wipe out their equity and make them technically bankrupt. This meant that small changes in market conditions could destroy the entire company within a matter of weeks. Multiple departments within Lehman were all using leverage simultaneously, which multiplied the risk far beyond what the overall company ratio suggested. The mortgage department was using leverage to buy mortgage-backed securities. The trading department was using leverage to buy corporate bonds. The private equity department was using leverage to buy company stocks. The real estate department was using leverage to buy commercial properties. Each department thought they were managing their own risks, but they were actually creating a company-wide vulnerability that nobody was monitoring. The risk multiplication worked like this.